Okay, hi everybody. This is March the 26th, and this is show number 15, if I am correct. Oh, right?
That is
Number,
correct.
that number 15. And this is the Physics of Bitcoin show with Giovanni and Stephen. And the idea of the show is that we are both a PhD in physics, in fact, in the particular branch called astrophysics. And so we went from studying the universe, at least, the large universe, to study the Bitcoin universe. And we are using basically similar tools to what people have used in the physical sciences, some of the same math, some way of thinking about the data. And it seems to work very well with Bitcoin. People have applied these techniques to many different fields, including economics. But Bitcoin, in particular, it seems to really work well with these tools. That you can explore Bitcoin using these tools because it has a lot of regularities that are not observed in other assets. Of course, everybody that is familiar with my and also Stephen work know about the power law. The power law is this behavior over a long period of time that seems very unique to Bitcoin in terms of assets, but it's something that we find in nature many times. We don't stop there. We apply many other approaches that are more, let's say, mathematical oriented and evidence based. And so this is what we are trying to offer um, in this series of videos in this show, because not many people do that, and so it's a pretty unique approach, and hopefully is of value. I know that sometimes we go into technical details that maybe it requires a lot of attention and focus, but it's why we record them so you can go back to it, you can try to follow, and always, ask us questions both during the show, but you can also do through DMs. People contact me, ask me question afterwards about the show or some of the concepts. So we are both available to try to basically educate. This is one of our goals, and sharing our passion for physics and Bitcoin. Do you want to add anything else, Stephen?
Yeah, well, thanks everyone for joining. And I know it does get technical sometimes, and that's the nature of it. It's physics, and by its nature, it's technical, and sometimes the math can get a little bit complex. The core math really for the power law is not that complex. If you know how to take a square and you know how to take a cube, you know how to do the basic power law of how the price grows. You know how to do the basic power law of how the addresses grow with time. It's just we end up with things that are a little bit fractional. They're not always quite integers. So you'll hear things like the 5.8 power, which means it's somewhere between the fifth and the sixth power, but closer to the sixth. And it's going to get technical. This is why we have to use logs. And in order to see the underlying relationship, you have to use logarithms. But we do our best to explain it. And, that's really all we can do is try and explain it and take your questions. My set of slides today are going to be a little less technical than they've been the last couple of weeks. And I'm going to talk about the Kelly criterion, and some of it is completely model free. So you can just do things with percentages.
You want to share your slides?
So yes, if you've got nothing else, I'm ready to dive in, and I'll share those. All right, go full screen. Okay, this is our 15th show, and the title for today is Kelly Criterion for Log Wealth Optimization. John Kelly introduced this in the 1950s, and he worked at Bell Labs, part of AT&T long ago. And Bell Labs is famous for many things, including in astrophysics. They discovered the cosmic microwave background radiation at Bell Labs in 1964 and 1965. And the Kelly criteria dates from a decade and a half earlier than that. And it comes out of Claude Shannon's work in information theory, also at Bell Labs. And he was basically looking at the issue of signal to noise ratios in telecommunications. And John Kelly was one of his coworkers. And he said, well, how can we apply this to, first of all, casino betting or any sort of bet or any sort of really financial series where you have a series of returns, you have an outcome, you have some probabilities. So that's the background. And what we have for the agenda is a quick intro to Kelly optimization without getting too much into the hairy details of the math. It's actually quite simple, the formula that comes out. But there are different versions of Kelly. So we're going to focus primarily on the classical gambler's Kelly, which is the first one that Mr. Kelly derived, and then look up then at the continuous version, which actually looks a little bit more like what we've been doing the last couple of weeks, the MVSK, or the Markowitz with a mean and a variance kind of model. And our starting point is all of the major asset categories in the past 10 years of returns. And that's going to give us a really compelling result using the Kelly tool quite simply. And so we'll first look at one asset, Bitcoin versus cash. And then we'll look at two assets, as we've done, in the previous couple of weeks with different techniques. Bitcoin versus the general stock market with the S&P, the SPY ETF, or gold. And then all three assets together. Okay, so basically what the Kelly does is it seeks to optimize the growth of the logarithm of your wealth over time. And there are many papers written on this, and it turns out maximizing log wealth is a really good way to go. And it also plays well when you consider our human responses, our sort of fight and flight reaction to losses. And so this is designed to avoid ruin, and it's designed, to keep you in the game, and it's designed to have the size of your bet be scaled to the probabilities and also the payoffs. And there are whole books that have been written on this. The one that I've used as a reference is the Kelly Capital Growth and Investment Criteria. It's got articles by many people, including famous people like Paul Samuelson in economics, and Kelly and Thorpe, who's been a big player in this world. And so the Kelly principles are to embrace risk, avoid extreme risk, but get the maximum long-term growth, balance utility of wins and losses. So it really depends on two numbers. One is P, which is your probability of winning, and one is B, which is your payoff. So even bet is a one-to-one payoff. Maximum long-term growth, balance utility of wins and losses. Giovanni, we've got some feedback. So it really depends on two numbers. One is P, which is your probability of winning, and one is B, which is your payoff. So even bet is a one-to-one payoff. Maximum long-term growth, balance utility of wins and losses. Giovanni, we've got some feedback. So it really depends on two numbers. One is P, which is your probability. So if your starting wealth is W sub 0, and if you bet fraction F of your portfolio, and if the payoff is B, then after you win, you'll have 1 plus B times F. So if you had, a portfolio of $100 and you bet 20, and the payoff ratio was 2 to 1, then you'd win $40, right? So your wealth grows from 100 to 140, 40%. If you lose, you end up with 1 minus F. So what you do is the expected value, you want to take the logarithm of that. So it's basically two terms, the winning and the losing term, but they're logs. And you do differentiation in order to find the maximum of that. And you get this algebraic expression. And when you solve for that, what you get is this very simple equation. F equals P minus Q over B. Now, P is your probability of winning, and Q is your probability of losing. So P plus Q add up to 1. Q is just 1 minus P. And B is the payoff ratio. In other words, if your bets pay off more than your losses, right? Now, you might think that if, and this example has P of 0.6, you might think that if I have a probability of winning of 0.6, I might want to bet, more than half of my portfolio, but it turns out you do not with an even payoff situation. And that's what this curve is showing. So what you have in this case is P of 0.6, Q of 0.4, and B of 1. And it turns out that the optimal fraction is the difference of those. It's 0.2. That's going to make you the most money over time. And then when you place your second bet, you say, okay, I won last time and I bet 20. So now I have $120 instead of $100, and I'm going to bet 20% of that. So my next time I'm going to bet $24, right? So your wealth is growing logarithmically. And then, of course, sometimes you're going to lose. And when you lose, you're going to be pulled down by that proportional amount. It turns out that the shape of this curve is such that if you bet more than $38, you'll lose money over time. And the problem is this asymmetry of losses, which is, if you lose 20% to get back even, you need to gain 25%. And if you lose 25% to get back even, you need to gain 33 1/3%. So as an example, if you had a losing streak of 2 off the bat with your first 2, and you were wagering 40%, your $100 would already be down to $36. And you'd need to gain 178% just to get back to even, which is very difficult. So you want to avoid ruin, you want to have long-term growth, and you want to balance the utility of the win and loss ratio. And that's why the bet size ends up being relatively conservative, 20%. And it takes you right up to the edge, the best you can get. Okay, now this slide shows the last 10 full years of asset class returns for 16 major assets. 16 major asset categories. And it turns out eight of these are actually debt. And so we don't care too much. They don't pay that much. Even emerging market debt turns out not to be a very good bet here. And as those of us who have been in Bitcoin for a while know, Bitcoin has won 8 out of the 10 past years. So just this chart is already suggesting that you should have a relatively high portfolio allocation. But the question is now, what does the Kelly criterion show, considering that we also have, when we do have losses, they're quite large. So we end up having the worst year in 2018 and the worst year, we were the worst of all these 16 categories in 2022, losing 75% and 64% respectively. So we're either winning very big most of the time, or we're losing bigly, as it were, 1/4 of the time, roughly. 20% in this case. Okay, so let's just apply that formula. And now I've applied it to all 8 of the asset classes that are not debt. And none of the debt turn out to be interesting. So we have Bitcoin, we have broad tech stocks, we have small caps, we have large caps, real estate, gold, commodities, and international equities. And they all had decent win records. They either won 6 or 7 or 8 of the 10 years. So that's the column P. That's the 0.8 or the 0.7, which is 80%. Now the W and L columns are the average win size and the average loss size. So I take the 8 Bitcoin percentage wins, I add them up, and I divide by 8. And the average win was 292%. Obviously tended to be higher in the early years than in the later years. The average loss was 70%. Now, this B is just the ratio of those two. It's the absolute value. So you take the sign off of the loss, take the ratio, and it's 4.2. And then if you calculate F as P minus Q, where Q is just, in this case, 0.2, 1 minus P, you get 75% for Bitcoin. that says that the optimal allocation in a 2-asset portfolio with Bitcoin and cash based on the last 10 years of annual returns is 75%. Now, you can subtract a risk-free rate, and I use 4%, and it only lowers the B very slightly, and it only lowers F just a very small amount, but it makes a difference for some of these other assets. So nothing did as well as Bitcoin, not surprisingly. Broadtech was next with 0.66, but if you apply the risk-free rate, then it dropped to 0.61. Small caps, 0.26, but compared to the risk-free rate, it went negative. Large caps, more like the Broadtech, 0.52, 0.53, but then it dropped to 0.4 once you took out the risk-free rate. And all you're doing is subtracting 4% from each of your wins and 4% from each of your losses when you do that, because those are all annual. Real estate went from 0.19 and then it went negative after correcting for the risk-free rate. Gold was reasonably strong, but then it dropped to 0.09. Commodities started out negative, then they went out really negative. We know that the last decade has not been good for commodities. International equity started out positive, but went negative. Now, you might say, well, Bitcoin, it had really phenomenal performance the first few years, and this is what we expect because it's followed a power law. But if you just take the past 5 years, you still won 80% of the time, and you still had a B value of 2.3. Your payoff was 2.3 times win to loss. And so the F value is still quite high, 0.71, and even correcting for the risk-free rate, it only drops to 0.70. So the takeaway is a 2-asset portfolio, the classical Kelly analysis, you can put 70 to 75% into Bitcoin. Now you can then ask, what if I pick 3 assets? And what would those 3 be? Well, the ones with the highest numbers before correcting for the risk-free rate, and I think even after that, are Broadtech, large caps, and gold. But Broadtech and large caps are pretty similar. There's a lot of correlation and overlap there. So I just picked Bitcoin, Broadtech, and gold for this 3-asset analysis of the portfolio. And I took the risk-free rate out as well. And so you basically take those numbers, 0.75, and you take the Broadtech number, 0.61, and the gold number, 0.09. You add them up together, and that gives you something to normalize with. And you end up with 0.52 allocated to Bitcoin, 0.42 to Broadtech, and 0.06 to gold in this case. This shows the curve of the optimal allocation fraction as a function of year. So if you started out in 2011, 2012, you'd only have winning results and you'd say put 100% in. Then you have a losing year and it dropped down to 75%. Then it climbs back up, it drops back down. It's a little bit noisy there, but it always has stayed after the first 2 or 3 years, pretty much in the 70 to 80% interval as the Gambler's Kelly optimal fraction F. And you know this simply because you know that we've got, Bitcoin up 3 out of each 4 years, and there's 1 down year in the cycle. So F is just 0.75 minus 0.25 divided by this B. So what is B? Well, it started out really strongly. It was 42 in the first epoch. And I took 4-year periods starting 2011 once we had decent price discovery. It's not exactly lined up with the halving epochs, and it's actually crossing across when you had the big peaks. And then it dropped to 7 from 2015 to 2018. It dropped to 2 for the 4-year period from 2019 through 2022. And if you take the longer 6-year period, it was still 2.1. So recently we've had 2 edges. We've had the 3-to-1 edge of the probability of winning, 75 to 25. And then we've had a B ratio greater than 2. So if P is 75% and B is 2, that tells you you should probably at least have 62, 63% in Bitcoin, just comparing it to cash and debt kinds of assets. This is a quote from Warren Buffett on diversification. He says it's protection against ignorance. It makes little sense if you know what you are doing. I think most of the people that call know more about what they're doing than Warren Buffett does when it comes to Bitcoin. He's got in his last portfolio, I think he had 28 assets. So, it's concentrated from the stock world kind of view, but he doesn't have any Bitcoin in there. Certainly not directly, but over time he will, as it enters into more and more corporate treasuries. Another quote about diversification is Wall Street's way of saying, give us your money so we can have a lot of trading fees. Okay. Now, 2 and 3 asset Kelly. This is still with the classical method. For this, I use monthly closes over an 8-year period because I wanted to filter out some of the volatility of earlier years and some of the higher return of the earlier years, because we know those are in accordance with the power law nature. So I didn't want to overweight the first half of Bitcoin history is excluded in this. And I looked at monthly, quarterly, and annual rebalancing intervals. And what you find is if you take a longer period, your Kelly fraction goes up. The noise drops, the signal goes up, and quarterly says you should have a higher fraction. Annual rebalancing says you should have an even higher fraction. And I looked at both Gambler's Kelly and Continuous Kelly, and we have to look at Continuous Kelly in the context of the power law. So I'll show you that as well. The answers get a little easier less easy when you start putting multiple assets into the portfolio. This is 2 assets just with Bitcoin and gold. But the answer is the one I just showed you, which is 52%. This is a slightly different analysis, but it gave the same result as I just showed you before, where you had Bitcoin and stocks in gold. But in this case, it's just Bitcoin and gold, and it's 52% into Bitcoin. And I also did equity curves. So the light green is the buy and hold, where we're 100% Bitcoin. And then the other curve is, this Kelly optimal portfolio, where the F is varying. On average, it was 0.6. The final value is 0.52. And you don't do as well. It's not surprising. It is more conservative. And so if you had just bought and hold, you'd have nearly 3 times as much with Bitcoin, but you would have much bigger drawdowns. And then the next one is, the title is mislabeled. This is Bitcoin and SPY. So this is Bitcoin versus stocks. It's a somewhat similar result. It doesn't do quite as well. It had the same 52% allocation. It had the same average of about 60% allocation to Bitcoin, the rest to SPY stocks. And you ended up with 23,000 at the end of the 8-year period, as opposed to the all Bitcoin that we saw was 78,000. This is 3 assets annual. So this shows all the numbers for Bitcoin, gold, and SPY in dollar terms at the start of year 1 and 8 years duration. So the end is the start of year 9. Bitcoin went up by a factor of 78 during that period. Gold and SPY went up by the same ratio, 2.4. That win or lose column shows win-win-win means all 3 assets won. Lose-lose-win means Bitcoin had a losing year, gold had a losing year, SPY had a winning year. And then you have the percent gains for each asset, year by year. And you just feed those into the process. And in this case, Bitcoin had 5 winning years. Now, the reason is that I did this from, I kind of wanted to see the sensitivity to the January 1st boundary. So I did this from mid-March 2017 until now, mid-March 2025, just to kind of measure the sensitivity there on when you start your year. And so we actually didn't win 3 quarters. We won 5 out of 8 with Bitcoin, 0.625. Gold did well. It won 7 out of 8 of these years. So it has the highest p-value, and stocks did pretty well as also. But Bitcoin has the highest b-value. You know, the payoff, the winning payoff is 9.4 to 1. Gold did well, 4.6. Stocks, as we've seen before, is a little over 2. And so the F ratios are about 0.59, 0.85, 0.64. If you then normalize them into a portfolio and also correct for the risk-free rate, you get this F star, and then you end up just with 32%, in this case with Bitcoin. It's about a 3-way split, actually. But Bitcoin improves a little bit relative to gold and SPY because it doesn't get hurt much by the risk-free rate of 4%. So this is why I say it's a little more complex when you start putting multiple assets in. And this is a summary of all the classical Kelly results, including all 3 assets, or just Bitcoin versus gold or Bitcoin versus SPY, and then looking at monthly windows, quarterly windows, and yearly windows. So if we look at Bitcoin versus gold, the middle column, we see that the Bitcoin fraction goes up the longer term you take. It goes up from 0.28 up to 0.52 versus gold as the present day allocation, and very similarly against stocks, against SPY, from 0.29 to 0.52. With 3 assets, it kind of jumps around. It's always at around 1/3 once you correct for the risk-free rate. Now, one thing noting here is that the correlations are high between the assets. Bitcoin and gold measured from monthly data over this period have an 87% correlation, and the other 2 correlations are high, above 90%. So actually, Bitcoin gold has the lower correlation here, which is more reason to put it in gold into a portfolio with Bitcoin than SPY, for example. Now we shift to the continuous Kelly, and this, at first blush, can give you quite different results and not enough Bitcoin. And that's because it doesn't realize that there's a power law. For people who have attended the last couple of sessions, you've heard about MVSK, which includes skew and volatility. Here, if I did not include skew except to sensitivity test it, so I started out by just mean and variance. But with continuous Kelly, the formula is different than it is with Markowitz. Markowitz is trying to optimize the Sharpe ratio, which is the mean return relative to the standard deviation, whereas Kelly is just maximizing the logarithm of the growth of wealth, and the mean and variance come in implicitly, but not explicitly. They come in through their compounding effects. But unlike the classical Kelly that's model-free, really no assumptions, it's just a set of numbers you work with, here you're implicitly assuming exponential growth when you take that mean, because the implicit assumption is that the mean is kind of constant over the interval and it's converging to some kind of ongoing trend value. We know Bitcoin is not that way, that it has a power law and the compound annual growth is continually dropping in a steady way. And also it assumes, the continuous Kelly assumes Gaussian residuals. And we know Bitcoin doesn't have Gaussian residuals. It has a very fat tail. Or really, it can be modeled as a double Gaussian, as we showed 3 and 4 sessions ago, I think, with a Gaussian for the core of the power law and another Gaussian for the bubble zone. So if you have a 3-asset portfolio and you use the formula here, which is the mean divided by the variance, which is the square of the standard deviation. And then you can subtract out the risk-free rate also from the mean. You only get 8% allocation, and everything goes to gold. And the reason is that gold has better variance or lower variance than both SPY and Bitcoin. You know, we view volatility as a feature, not a bug, because we have some understanding about how that volatility behaves. So I'm going to correct for this. First, I added skew to see if that would matter, because Bitcoin has this nice, you know, right tail skew, but that didn't help. So here's the core problem of Kelly, continuous Kelly versus MVSK. The asset has high positive skew, favors MVSK like Bitcoin. When volatility is extremely high, with the variance term will dominate, and then you have the correlation structure that plays into MVSK. And the conflict happens because Kelly optimization penalizes high volatility even when the skew is very favorable for us. High positive skew increases the expected log return, which is what we want, but it gets swamped if the variance is excessively high. So in the blue text, I kind of netted all this out because it's a little subtle what's going on here. The main core problems with Bitcoin are that you're not detrending with the power law and you're not using dual Gaussians. So I then said, well, okay, chat, what do you think about this? You know, Bitcoin has much higher long-term return, and yet the 3-asset portfolio with the classical Kelly only gives it 32%, and with the continuous Kelly even less. Chat, what would you do looking at the series of prices for 32 quarters? If you just had to pick two, what would you do? Well, it said I would pick Bitcoin and gold because they have the lowest pairwise correlation. And I asked, why wouldn't you pick SPY? Because that high correlation between Bitcoin and SPY, and also between gold and SPY, reduces diversification. And SPY has negative skew, which is undesirable. So what I did was I detrended before applying the continuous Kelly with its mean and variance. I first detrended by the power law, which we also did for the MVSK analysis. And when you do that, the optimal portfolio allocation flips dramatically and becomes 78% Bitcoin and 22% gold. The only kicker is you don't want to rebalance. You just wanted to have held that through the whole time, because the buy and hold was 77% Bitcoin, dramatically outperformed. It reached 66,000 in the equity curve after 8 years. Whereas if you were reallocating quarterly, what's called dynamic Kelly, you'd follow the red dash line, you didn't make any money. And the blue line was a static Kelly allocation. It's somewhat mislabeled. It looked at the optimal Kelly each quarter and then used that. And you only ended up at several thousand, 3,000 and something. So really what you wanted to do was buy and hold. And the takeaway is that you want to rebalance. This is the opposite of castling in chess. You know, in chess, you want to castle early and often. Here, you want to do the opposite. You want to rebalance little and lazily. This is the dual Gaussian, you know, that we plugged in. And you can make a slightly different twist, which is you can look at those two Gaussians for the core power law and for the bubbles, and you can combine those variances by taking the sum of the variances, which is the sum of the deviation square, weighting them each by a half, and you get a new variance that you feed into the continuous Kelly formula, and you get the same answer. Kelly fraction, 78%. So it's just another way of validating what I showed on the prior one. So in summary, dominate your portfolio with Bitcoin. Gold is a good hedge. There's a lot of variation and complexity. It's confusing if you use a continuous Kelly. And if you go look at some of these sites that optimize, they tend to use the continuous Kelly. So you want to really check into how they're using it and over what time period. The longer time period, the more trouble you're going to get into because it's not aware of the power law. If you use classical Kelly just versus gold, you'd say 52% for long term, for a year. If you use it just against cash, again, you're in the 70 to 75% range. SPY doesn't particularly help because of its negative skew. And if you look at three assets, it really underweights Bitcoin because it only puts a third into Bitcoin. And we know because it's gone up so much more than gold and SPY does that that's really not the right answer. So if you then correct for the power law, even with the continuous model, it says just 78% Bitcoin, and you can hedge with some gold at the 22% level. So message is let go of diversification. We've all been trained over decades by the financial industry with this, right? And one of the takeaways for me is I probably need more gold and a little more or less stocks in the hedge portion of my portfolio. I've been in the 70% because I've been doing Kelly for a long time. So I've known with classical Kelly that 70% is a good allocation. But maybe gold is a better hedge than stocks. So thank you for watching. And I'll turn it over to you, Giovanni.
Right. Thank you so much. Very interesting presentation. I would eventually I'm going to do some correlation studies between gold and Bitcoin. It seems you did it, but again, one of the issue will be, is there any delay, for example, that could be included in the analysis? And then if there is a delay, are there some seasonality? We know that there are the cycles, but independently from the cycles, are there some sign of seasonality or cyclic? Because the rebalancing, if you do it at random time, then maybe it's not a good idea, right? But if there is some level, because it's maybe independently from the cycle, because the cycles have been very precise so far, but we have some sign that maybe something is different this time, right? We are not sure yet, but there are several signs that maybe the perfect cyclic nature of Bitcoin that we observe so far is not going to be observed. But maybe there are still some level of seasonality, some level of cyclic behavior that can be used, because if you could time it, right, if you could time your switching between one asset to the other using this seasonality, then maybe there is some level of optimization there. But it's something to be explored. We will need to explore it later. But it's very interesting. But I like both assets, gold and Bitcoin. So yeah, it's a good idea. It's a to have a little bit of something else, but yeah, so far Bitcoin seems to be the simple choice, right? Independently. But I really like this approach. Did you try? I think it's kind of related to your idea of skewness, but did you try other measures like Sortino, for example, instead of making a Kelly, continuous Kelly, that you, instead of using, the Sharpie ratio to use.
Did you say Sortino?
Yeah.
Yeah. No, I did not. I did not look at that.
Yeah, and you know about Sortino, of course, right? You have heard.
Not much. I haven't worked with it. I mean,
It's similar to Sharpie, but instead of taking the standard deviation of everything of all the returns, it takes the standard deviation of the negative returns.
right. Yeah, it's trying to protect you against the drawdowns.
Right.
Yeah.
And so it could be interesting to see that. Yeah, because you are using, you're taking this large mean. So maybe yeah, we know of it.
That would hurt. I'm quite sure that would hurt Bitcoin because you
Well,
would
we know that we are
you'd lose all the upside that we
yeah,
know.
we have bad drawdowns, but this will be an average, right? Because
Yeah.
it will be average over the 4 years. So I'm not sure because we don't have, we have 3 years with large positive skews, and then we have 1 year with a large negative skews. How an average of these will look like, right?
Well, it's the worst of all assets, right, for drawdown.
No, for 1 year, for one single year, right?
Yeah, but if we're only weighting the downsides.
Yeah.
Yeah.
No, but I will be still average over the 4 years, right? The downsides over.
No, well,
because it will be average over the entire history, right? And so
yeah, you're gonna it's gonna throws out the positive skew.
Right, but the negative skews during the positive years should be small.
The negative skew during the positive years is small. It's yeah.
Right, because you have a lot of positive skews.
We'll have to run the numbers to know for
sure. Yeah,
we'll
have to run the numbers. I'm curious myself. One time I did Sharpie ratio as a function of time, and actually, over time, of course, the Sharpie ratio was going down. But we could track with the Sortino too. It will be interesting actually to compare them. In fact, maybe 3 or 4 measures like that. But that is another thing that we can explore. Anyway, it's very, very interesting topics. All right, so I'm going to share my slides. Okay. And I'm going to try, like always, but I always fail to make it bigger. I don't know. What do I do wrong?
Slideshow.
Yeah, this is what I try all the time.
Oh.
Slideshow from current slide.
Yeah.
Does it look bigger? No.
No, it didn't change.
It didn't change. I don't know why. Okay. I don't know what am I doing wrong. Let me try a couple of things. I can try this thing, like here. I wish there was a way full screen mode. What about this? Better?
No, it's the same.
It's the same. Yeah, it seems almost like it's not responding to whatever. Because, for example, I just close the ribbon, what we call the ribbon. Always show ribbon, show tabs only. Oh, nothing?
No.
All right. I don't know why. Let's see. Now? No.
It's better, yes.
Okay. So anyway, I'm continuing my. So just actually to summarize what we did before, if people maybe missed the previous episodes. So I started to. It's a long time actually, several months that I've been playing with this idea of global liquidity to see if there is a relationship between the two. I made a model. I wrote an entire article about that. If you take the entire history of Bitcoin, all the data that we have, it doesn't look as clean as this graph. It looks like if you go to the early year, this curve starts to bend a little bit. So that means it's not a simple power law. So I'm taking here, like always, whenever we do, when we're looking for this power law relationship, we take the log of one quantity versus the log of the other. The global liquidity here is M2. I tried to add other measures, so like the one that I could get access, easily. Mostly what is available on TradingView. It is not the best source for liquidity measures, but we have several. We have banks, private, and I try to add other things, and it doesn't change much. So whenever Howell, for example, talks about this model, I want to understand it better and see if I can reproduce. But so far, simply adding more complicated measure doesn't help too much. It looks pretty much similar. So M2 remains a pretty good measure. I also try to do, and maybe I present next time, to break it down in terms of the contributions. And of course, right, it's the results are pretty obvious. China and the US are the strongest contributions. There are other countries that contribute, but not as strongly as the US and China. And China and US are strongly correlated. That is the other thing that I calculated. I make a correlation table of all the different liquidity contribution, but I don't have it here. I posted on my X, but we can talk maybe next time about that. But if you focus on the last 10 years, the relationship now it's much cleaner, and it's still pretty relatively long period of time, right? 10 years. And maybe it's more relevant because markets anyway change over time. One thing is to show the overall power law, because it's basically a way of showing how regular Bitcoin has been, and there is a reason why it's growing like a power law. But then, maybe as a predictive tool, looking at a more relevant period of time, like the last 10 years, because the economy is changing, the world is changing. So maybe it's more relevant to focus on the last 10 years. But it's a very powerful relationship. It's clear that as one goes up, the other one follows. Now, there is one main issue, that is this delay that is discussed a lot all over X. So it seems there is some kind of delay. People debate. I think it's a variable delay. There is no one single delay. In fact, my Granger Causality test that we're going to see in a moment kind of show that there are times where in fact, one quantity can even lead the other. It's not always, for example, global liquidity that leads Bitcoin. It seems kind of obvious. There are other times where one leads the other, and other times where they are not correlated, where the correlation is small. If you look at individual little chunks of data. So I think it's a complicated relationship, but in general, if you pick one of these, kind of relevant delays, anything around between 60 to 120 days, it's a very strong correlation. It's not due to chance. You don't get this kind of visual, fantastic correlation due to chance. Now, assigning causal relationships, saying, well, liquidity is what causes this, is another matter. So here, it's mostly a correlation. Then, probably there are other things that drive both of them, and maybe one is affected by these global things earlier on. So these are things that need to be understood. Now, this correlation can be used to make a model of price, because basically it's a power law with this power 9.3. By the way, that 9.3, like many times when we talk about power law, we try to emphasize this over and over. It's an incredible nonlinear multiply. Multiply is not even the right description, because you're taking the power. So just to give an example, I know it sounds crazy, but a change in liquidity of about 10% is supposed to create under that 9.3 relationship, right? Power. So if you take the power of 1.1, you get 2.4. That is completely crazy. So it means that you kind of expect a doubling of a price under a 10% liquidity change. But I had to double check it, triple check it, because it sounded crazy.
Yeah, no, it's right. I mean,
yeah, and that means small. It's basically Bitcoin reacts very strongly to liquidity, and this is what it is. And it kind of fits, right? If you think about the interpretation of that, it fits with our understanding of what Bitcoin is supposed to be, right? People are moving around their assets, and somehow eventually they found themselves, at least a portion of humankind, decides to invest in Bitcoin. And some people do it short term, many people do it long term. This is why you see these very long term type of trajectories, and they get rewarded with these incredible returns, right? So the little liquidity that finds Bitcoin gets multiplied by a huge big fat. So it's a very interesting thing. And again, yeah, the model is not perfect, in particular, in the details of, if a price is above a red line or below the red line, but in general, they follow each other. It's clear. And there are a lot of little features you see here. For example, how, this bottom corresponds to this bottom corresponds to this bottom, the peaks, you can see single features. And remember, all what we are doing here is taking the power of liquidity, right? So I take the liquidity, and then I take the power of 9.3, and I multiply by a factor that makes them kind of similar in value. And so here it's a zoom out, because here is basically I'm including a shift. This is why you see a little bit of a red line continuing, because whatever is happening to liquidity is going to happen eventually to the price, right? If there is a shift where liquidity leads most of the time, and this is a projection, but it is kind of bullish because we are supposed to be in this area, right? Again, do we have to wait 20 more days, 30 more days, right? In general, this delay it's about 100 days, but liquidity is already climbing. So before we climb, it will take a little bit more time, but it should happen soon, if this relationship is correct. Now, I wanted to use some more sophisticated tool to explore more of this topic. And so there are many tools that are not just looking at if two things are correlated to each other, but also if by looking at a particular gap. So the idea will be, okay, if I shift one of a series a little bit in one of the directions, do I still see, if I correct for that gap, do I still see some some correlation, right, when I include these type of gap? And so it's a technique that works in this way, like you're seeing a visual representation of these, like this one of these two series. These things are called time series when you study some kind of quantity that changes over time. And if there is a consistent correlation at a given gap, then you pass this test. That it's and so it's called causality, in the sense that usually, most of the time, when it's a necessary but not sufficient condition, right? That something needs to happen before to be the cause of something else, right? So it's necessary. It's not sufficient, because it's possible there is something else that affects both of them, and one maybe is affected first, and then the other one, right, is affected later. So you cannot say that X causes Y, because maybe there is Z that causes X, right? And then there is like a chain of reactions, right? And it's possible that this is exactly what happened with how Bitcoin is affected by liquidity. So you can run it at many. It's already a code that like an algorithm that is written. If you use Python, if you use there are libraries to do that. MATLAB, that is what I use many of times when I do these researches, as a function that is already written down that does this test. And usually these statistical tests, they tell you, okay, your hypothesis is confirmed. So they give you 1 or 0 or no, right? So you're testing it against a null hypothesis. So, for example, that there is no causality link. And then, you can pass it or fail. And if you pass it, then it calculates it calculates all kind of different statistical property. But one I think that is simple to understand is what is called the p-test, the p-value, or the p-value. Basically, what it gives you, it's the probability that whatever test you are, you are applying, it's due only to chance. And there is a lot of debate about this, if it is the best way to measure things, but and also what is the cutoff. In physics, we don't even use it much. We use something like sigma, for example. We look at the distribution of a value, and then we see how likely that these values that you're getting are away from the mean or whatever. We don't use p often, but it's used in many different fields. But the convention is just a convention, is that it is significant if whatever result you have has a p less than 0.05. It basically means that the whatever your results are at most due to chance, according to that p. And if they are below 5%, that is basically the hard cutoff, where they say, okay, it's likely that 5% is so small of a number that, the other way of thinking is that 95% of your data is not explained by chance. But okay, maybe there is something in the data, right? And of course, the smaller the number, better it is. And so this is what I'm showing here, the p-value. I have a little dotted line that is the significance level, 0.05, so 5%. And anytime we go below that, the result becomes significant. So it's interesting because, and of course, what they did here, they use a window. You can use many different type of windows. In this case, I use a 200 days window, something that is a little bit bigger than a year. Something that is a little bit less than a year. And so the window is moving. So basically, you are adding 1 point and taking away another point. You're moving, recalculating. So this allows you to have a kind of a continuous measure of the correlation in that little window, and correlation, but also this delay, right? And you do it in two ways. You do it basically, you're saying, okay, I want to see if this quantity leads this other one, right? So when you use this built-in function, it's which one comes first and which one comes second, right? So x and y. So in this case, you can put price first and then liquidity second, and you are basically testing for liquidity, so for price leading liquidity. Then if you switch it and you put liquidity first, you are testing for liquidity leading price. This is how it works. So I did it in both ways. You see, the blue line here represents the test where we are trying to see if price leads liquidity, and then the red one is that liquidity leads price. And basically, if you have in the second panel, if the red is above the blue, it means that is leading, that liquidity is leading, and vice versa. And then in the first panel, you see the Bitcoin price, so you can see where these particular regions line up with the price. And I even color coded. So, like I say, the last panel, I think it's easier to interpret. Every time the values go below 0.5, we should take it seriously because it means there is some strong causation with this lead. So one is leading the other. So, and I color coded where if a price leads global liquidity, it's black, right? These are regions where I mark with black. This quantity P, and this magenta color when is the liquidity. So, and you can see when I project basically these regions of significance into the price. Uh, you know, and so you can see whenever there are black dots and magenta dots related to certain structures in the price action, right? So when you do something like that, then it's a matter of interpretation. First of all, it seems, at least with this particular window, that they don't always correlate with each other. There are certain regions where they correlate more. Now you can also interpret the other areas with, well, there is no one leading the other, right? But I allowed even one day, so I don't know. I think I will tend more. Maybe Stephen, you can help me with this if you have some other understanding of this. But in that case, I will say that is more about not a strong correlation than, yeah, they are correlated, but there is no a delay. So there are critical places where they are strongly correlated. They pass the significance test, but also they show which one is leading the other, because the lower P means that is more significant. In fact, you can see many times where the P is low for one quantity, is high for the other. My interpretation of this at this particular time is that just before the bull runs, liquidity takes the lead. So it kind of initiates this process. And then when we are coming very high, relatively, so very, very close to the peak, is mostly price. And this probably what happens is price, these are, the liquidity continues to do its own thing, because we have evidence of that in other graph, right? It continues to go up, and then there is some kind of a correction, cyclic correction, but the price continues to go up, and so it seems to be leading the liquidity, and it goes faster, and it's mostly FOMO. It's driven by FOMO. It's FOMO that pushes up the price, and so there is some kind of reversal of a causality order. It's interesting to see here, for example, that this whenever we were remember when we were going down, we had this correction between 70 to 55. Liquidity was leading, and in fact, it was interesting because you could see that the liquidity was going up, the price was going down. I pointed out that so many times, and in fact, I thought, oh, that is actually pretty good, because the price needs to correct, the liquidity needs to catch up, and that happened for quite a long time. And then more recently, when we had this push up in November, before we reach the local peak, liquidity again was leading, and it was kind of waking up. Right now, it doesn't seem yet, probably because the price is catching up. If we really go up, like we saw this delay, right, where there is this particular delay where we are, liquidity is going up. If the price will follow up here and it starts to go up like that, then I think we will see more purple dots appearing on this chart. But it's interesting, and needs to be explored more. I want to try. So what I want to do in the following days, I want to try a sequence of windows, see if things change and how they change. I use one particular gap, but we could try many. So there are. This is one of the tools to be that can be used. So there are more sophisticated causality type of test that one can use. That also looking. So this one is more linear, but I'm expecting mostly a linear relationship between these two quantities because I'm taking the logs, and we already claimed that there is a linear relationship between the logs. But I think it's worthwhile to look at something more sophisticated and explore. And we can try with gold. We can try with other asset, even SPY and so on. But it's very interesting. One time I did it. When I did it, maybe I should share this in some other episodes. I did it with hash rate and addresses, and the results were also very interesting and very, very clear. Anyway, so this is what I have at this moment in terms of my exploration of this topic. Stephen, do you have any observation of any question about this?
Yeah, I'm not sure exactly how to interpret. It's sometimes you've got this Granger predictability or causality, as they generally call it.
Yeah.
But it's not, it's not there most of the time, right?
Right.
Not at the 0.05, which would be 95% confidence level.
Right. Exactly.
And so what separations did you test? And temporal
Right now, this one is about 100 days.
100 days.
Yeah.
Yeah. Yeah. So, Michael usually talks about 11 weeks or 13 weeks.
Yeah.
And I've seen other people talk about a little bit longer, like the 100 days.
Yeah. And there is a way of doing a Granger where you actually allow for a range of possible lags. And then it's trying to find the best lag in a dynamic way. And maybe you can even give us the lag. You can tell what was the best lag that gave you the best result. So it's just the beginning of these studies. But it's interesting and surprising that there are times where the price is leading. But I think the interpretation of that is that there is some kind of decoupling where the liquidity follows its own path, because of mostly FOMO driven, and you can see if these areas are mostly at the top. So that is interesting. At the top, or maybe when, for example, when there was this big gap, right? That was actually FTX. So that didn't have anything to do with liquidity. So the price was crashing, and so it looked like the signal came. Eventually liquidity also bottom up, but it bottom up faster for Bitcoin because it was driven mostly by Bitcoin related events like FTX collapse. So it's interesting. It's just that it needs some interpretation and maybe more data exploration to understand better what is happening here. Yeah. But it's not simple. It's much more complicated than people claim to be. That is one of the things that it's obvious, because it's not always global liquidity dominating over being the leading factor. Now we can calculate how many times liquidity was leading relatively to, by eye seems that liquidity, it's more leading. Most of the time is liquidity is leading just by the number of points involved, but we can maybe calculate it precisely.
I have something for you on the Sortino ratio.
Okay.
Which I just did something while you were presenting.
Yeah.
So let me see if I can
show
that. Yeah, here it is. I just generated one slide. Can you see that?
Just a second. Yeah, I do.
Okay. So this is with monthly data over an 8-year period.
Yeah.
This is calculating the Sortino ratio, which is the Kelly fraction, only using the downside of the deviations. So the standard deviation only when, it's dropping.
Yeah.
And I used a rolling 12-month window to calculate the standard deviation. And this plots both this, what's called the Sortino ratio, which is the return relative to that downside standard deviation.
Yeah.
And also the computed Kelly fraction. And I would say it's not very helpful because the Kelly fraction goes negative, substantially negative in 2019 and 2023. So it would have told you to go short Bitcoin.
Mm-hmm.
I'm not sure we want to do that ever because of the power law. And again, there's no explicit correction for the power law in this, right? So
yeah,
we could think about that, but and it starts a year later because it has to accumulate 12 months of data. So we're only seeing one of the peaks. We're seeing the 2021 peak.
I wonder if you're smoothing it over 4 years, though. What happens?
No, there's no smoothing. I mean, the smoothing is just the standard deviation, which is 12 months. If you smooth it over,
you can calculate the standard deviation over 4 years,
for
right?
48 months. Yeah, you'd be positive for sure everywhere. So
I would like to see the difference between the two.
Yeah.
Because I can do it, but you can try to. But I still have an intuition that Sortino will give you better because if over 4 years, 3 years we have positive skews, that means that the negative skews should be less, right? In average.
Yeah, but Giovanni, if you take the classical Kelly over 48 months, you're always 100%.
Yeah, I get it.
Right?
Sure.
You never have a down period.
Yes.
Yeah. So the Sortino's, I don't think going to exceed that.
But it does
here very briefly.
Look at the positive year, right? It actually goes higher.
It does very, very shortly. Okay, I have a plot. It does not look good. Let me see. I gotta just a moment. I gotta upload it to my machine. I'm going to stop sharing and reshare.
Okay.
This one. So you see what happens here is that the Sortino ratio ends up being at about 1/2. And the Kelly fraction ends up being less than 0.3. But you don't get started until 22, right? Because this particular one, it doesn't matter in a way because we're only trying to find out what we should be doing now. And what it says we should be doing now is only putting 1/4 of our assets into Bitcoin according to the Sortino, Kelly Sortino version, or the Sortino version of the Kelly. The classical version of the Kelly says we should be putting over 70% in. So I don't think it's helping.
Okay. Yeah, it's good that you verify. Very good.
Yeah.
Okay. Well, one could make another, we could a Perrenot measure where you divide by, or you multiply. How will you do it? Because you want to make it positive. So maybe you multiply by your sigma instead of dividing by your sigma, right?
Multiply. That's my catchphrase has always been Bitcoin has all the risk and all the reward that I need.
Yeah, exactly. Yeah. Very good. Okay, let's look at some questions. Mostly it's nice comments. Thank you, guys, to show this. Am I showing it? Show. Yeah. Yeah, this is what we are trying to do. Like, we are not trying to, to hype Bitcoin and sell FOMO. We are focusing on the math, and hopefully it's interesting, even for a minority of the people, but that is what we are trying to do here. Thank you. Other nice comments. Yes. Set up a GoFundMe for streaming class using PowerPoint for joy. Yes, I watch videos and I follow the instructions. I don't know. Maybe I need to try a few times. All right. Well, we don't have really any question, mostly nice comments. But, well, if that is the case, then we can conclude here. And we will be again here back in, because we will have topics to discuss basically forever, I think, because Bitcoin is a continuous source of studies and explorations and so on. So we will be here next week.
Next week, I think I'm going to talk about how much energy there is in each bubble and how does it decline from one bubble to the next.
Very good. And we can also talk about, they found this mining complex, Bitcoin mining complex under the pyramids. Have you heard about that?
Oh, yes. We have to check the Egyptian IP addresses, yes.
Exactly. Anyway, guys, see you next week. Thank you so much to listen to us, and and come up with questions maybe ahead of time if you like. Bye, everybody.